Welcome to Investors Insights, episode number 123. Today we will be discussing the countdown of the Federal Reserve and will they raise rates, or also will China mess up your portfolio? Also, if you like what you hear, let us know. If you don't like what you hear, let us know. And on top of that, if we do a really great job and you think it can make a difference for someone else, please share it with them. I encourage you to connect with us on Facebook, Twitter, and LinkedIn. Links are on our blog. So let's jump right in because we've got a short week and yet a countdown to an eventful time.
I'm Greg Powell, and this is Investors Insights.
You're listening to Investors Insights with President and CEO Greg Powell and the Portfolio Strategy Team at 5 Plan Partners. 3, 2.
Good to see you guys this morning.
You too.
Enjoyed our early morning debates. Mm-hmm. And let's just talk here. I think we've got several points that need to be made here. Number one, China kind of voiced this morning that they're starting to mature or figure out what a stock market does. From standpoint, they started to put in circuit breakers, correct?
Yep, they did.
Everybody agree with me on that?
Yes.
Yeah, long overdue. I think, and we'll talk more about this, the Federal Reserve, we've got a countdown here. Will they raise rates? What do you guys think? You think they'll raise rates?
I don't think so. And we've talked about it.
I don't think they'll raise rates, but I think it'd be interesting. We kind of touched on this a little bit that they may not have to. I think what's upsetting the market right now is that they're not being really clear on whether or not they will. It's the uncertainty.
Right.
And I think they're doing that. I think you brought up a good point that they're doing that too. Hopefully the market may raise it for them.
Yeah, sometimes the Federal Reserve will let the markets take care of themselves.
Yeah.
So, which I think we're seeing that. I don't think they can raise rates because globally it would really impact these other countries. You take Germany, for example, what their interest rates are in comparison. We think our rates are low. You go look at Germany, and people would automatically convert and start, buying dollars or going into treasuries. So speaking of treasuries, talk about what China's doing with their treasuries.
Yeah, so what's interesting, and this is Bobby brought this up this morning on how China's going to intervene in their market positively, and that's where you're seeing China up today, and that's because to intervene in their markets, China needs to throw in liquidity. Well, where does China get liquidity? Well, they hold trillions of dollars of treasuries, and so they have to liquidate treasuries.
U.S. treasuries.
U.S.-focused treasuries. So they have to liquidate those, convert them to Chinese currency, so then they can use that currency to help support their market. And so when they liquidate, when they're selling in the market, that raises our rates. That puts supply on the market. That happened. We saw it last week where our rates started to come down. China entered the market. Our rates flatlined. And where they should have continued to go down with the market turning negative, they actually went up. And that was because China is providing supply. It's pure supply and demand. And so you could see China intervention or China's trying to intervene in their markets, actually affecting our markets and keeping our rates higher, which could do the Fed's job for them.
So when people hear these commercials on TV about panic and disaster and those kind of things, and they're saying China is going to own the United States, they can at least relax knowing China is being forced to sell their U.S. treasuries to take care of themselves in their market, right?
Exactly. Yeah. It's the deepest, most liquid market treasuries. It's the only place they can go to.
And their reserves, their own reserves, are under tremendous pressure now. Trying to keep this up, they have to.
Yeah. So, and then from the standpoint of, let's talk about commodities, because we've had clients calling saying, I really want to buy some of those energy stocks. At this point, I think we're in agreement. Commodities across the board are in a bear market. Everybody agree with me on that?
Yeah.
You agree?
Yeah, that's the price bear we're seeing right now.
Yeah. And then the other thing that came up on our radar screens is that real estate has gone into a bear market, which could impact the Fed's decision to raise rates if they start to see real estate taper off.
That's because that's been one of the stronger parts of the economy year to date. Has been real estate, and so to see that really fall off could take into account the Fed's decision very heavily.
Right, Bob, you made some good points in the early morning meeting. Anything you want to that I haven't addressed yet?
Yeah, so we've had a lot of clients ask us, what's the big deal about the Fed? The Fed has said that if they do raise rates, it's going to be very small and slow. But the problem is the Fed is causing uncertainty. Trey, you said it earlier. It's uncertainty that is really hurting us in the markets the past few weeks and causing all the volatility. It'll be very interesting I think the Minneapolis Fed president speaks this afternoon.
Yeah,
maybe we
that's
can
right.
get a hint with what he thinks. But it's the uncertainty that has really hurt us the past few weeks, along with China, of course.
Right.
So we're watching things very closely, but we do not think they will raise rates.
Well, and let's talk about that for just a minute. If we could write the perfect script based on research that we're doing, and I want to preface by saying there are no guarantees, but really what we've seen the whole issue with China, and it's still out there. That's going to continue to be a discussion over these coming weeks. Then monetary policy with the Federal Reserve, will they raise rates? And that answer should come out September 16th and 17th.
Right.
We should know if that event is going to take place. And so at that point you go, oh, thank goodness we're through that. The other one that we are seeing on our radar screen is politics. Congress and the president go back into session, and it's going to be very nasty. And, the news is going to pick up on that. The media is going to really go after it. They have to raise the debt ceiling, which can cause havoc in the markets. If you've got politicians going, you know what, I'm not going to vote to raise the debt ceiling if you don't vote for something I want. Also, you've got the highway funding bill. That's going to be a big issue in terms of job creation. And then the last, although there's a long list, is the Iranian deal, which is going to be a whole global debate and discussion. You're going to see nations get into the discussion along with Congress and the president. And from there, we see the volatility, and you guys can elaborate on the volatility, but the volatility is going to be with us September and October. Agree?
Yeah, the cat's kind of out of the bag on volatility. It's going to be hard to get it back in with the next cycle heating up.
Right, but we, from our standpoint, we have tried to navigate that by moving people in our portfolios into cash. We've taken a larger cash position at this time. And to also, from the standpoint of that volatility, as people are looking at their portfolios, if you're looking just at your statement, that's a one-time snapshot. If you want to see valuations on an ongoing basis, then I would encourage them to look at Account View. Agreed?
Yeah.
Account View, you go to our website, which, by the way, Chris Davis in our office just recently upgraded it, but you can see a button there to click on that says Account View, and view your account, and you can see what your value is on your overall portfolio as well as moves we make. You can see that 24/7, and I think that's real important in the use of technology right now.
Oh, it's great. It's great tool. Yeah.
Right.
Because every day or snapshot, you don't want to be handcuffed to just one moment in time.
Right.
With this much volatility and how opportunistic we think the rest of the year could be for the U.S. economy being strong, you want to look at the whole picture.
Sure. Right. And that says a lot. We've got a few more months here of this 2015 year. That said, is that with the volatility in the past couple of weeks, needless to say, have not been dull. Have not been dull at all, and at times frustrating. But we've tried to proactively move to reduce the volatility and get through the storm, so that as we get into November and December and the economic news improves, that's good. Case in point, if this Labor Day weekend, if you went to the gas pump, you may have actually seen $1.98, $1.99 gas. Well, to the consumer, that's a jump start to a good economy. To the guy in the energy business, not so much.
Not so good.
That's what we call a bear market. So anything else you guys would like to add?
Yeah, just one other thing on the Federal Reserve we talked about this morning. Part of the problem we're having, and yet another reason we don't think the rates are going to go up, is housing. We've mentioned that. Housing's improved, but the guys we were debating this morning, it's shifted to where it's going now. It used to be that housing would really pick things up because you went out into the suburbs, you bought cheap land, you built a house. That multiplier was about 2.5 times jobs on the house you built.
Right.
Now people are kind of like they are. Greg reminded me this morning in Birmingham, it's a great example of it. People are moving back downtown.
Right.
They're going into lofts. There's not a lot of buildable land. Plus the construction wages have gone way up because post 2008 people got out. So our point in that is,
people in the construction business got out.
Oh, construction got out.
If you're a contractor.
Exactly. And our point on that with the Federal Reserve is that's a change in the way the historical data has looked.
Right.
So that's hard for them to get their hands around, too.
Sure.
So,
yeah. So on that note, we will keep you updated. If you want to talk to us about your portfolios, don't hesitate to call. We will be reaching out to our clients as well. And make sure that you continue to watch this vlog. Have a great week.
More information at fiplanpartners.com. Securities offered through LPL Financial, member FINRA, SIPC.